Ever wondered how small businesses manage their cash flow while waiting for invoices to be paid? It's a common concern, and there's a solution that might surprise you: Invoice Finance Loans. You see, cash flow is the lifeblood of small businesses. Without it, growth stagnates, operations falter, and dreams can crumble. But with the right financial tools, like Invoice Finance Loans, these problems can be mitigated. So what exactly are Invoice Finance Loans? Stay tuned to find out. Invoice Finance Loans, a term that may sound complex, but in reality, it's a straightforward and effective financial tool. Let's break it down. Invoice financing, also known as accounts receivable financing, is a type of business loan where companies sell their outstanding invoices to a third party, often referred to as a factor, at a discount. The factor pays the company a large portion of the invoice amount up front, typically around 80 to 90%. This immediate payment can be a lifeline for businesses that need to maintain a steady cash flow. But what happens to the remaining 10 to 20%? Well, it's held by the factor until the customer pays the invoice in full. Once the payment is received, the factor will then pay the remaining balance to your business, minus a fee for their services. This fee is usually a small percentage of the invoice total. The beauty of invoice finance loans is that they allow businesses to get their hands on the money they're owed without having to wait for slow-paying customers. Think of it as a way to bridge the gap between the work you've done and the payment you're waiting for. This can be particularly useful for businesses with long payment terms, or those that often deal with customers who take their time to pay. With invoice financing, instead of waiting 30, 60, or even 90 days for a customer to pay, businesses can have most of that money in their bank account within a couple of days. It's a way to keep the cash flowing, even when your invoices aren't. Invoice finance loans can be a smart solution for businesses that need to maintain a steady cash flow. It's about freeing up the capital that's already yours, just tied up in unpaid invoices. This way, businesses can focus on what they do best, growing and expanding, without being held back by cash flow issues. So you see, it's not as complicated as it sounds, but let's delve deeper. Now that we understand what invoice finance loans are, how do they work? Let's break it down into a step-by-step process to make it more digestible. Firstly, it all begins with an invoice. As a business, you provide goods or services to your customers and in turn, issue them an invoice for payment. This is a standard process in any business transaction. Next, rather than waiting for the customer to pay, you sell this invoice to a third party, known as a factor. The factor is basically a financial institution that deals specifically with invoice finance loans. You're essentially selling your debt to them, which can be a great way to free up immediate cash for your business. Once the invoice is sold, the factor will provide you with a percentage of the invoice's value upfront, typically around 80 to 90%. This cash injection can be a real lifeline, allowing you to cover immediate expenses or invest in growth opportunities while waiting for your customers to pay. Now, the factor will then take on the responsibility of collecting the payment from your customer. This means you can focus on what you do best, running your business, while the factor chases up the invoice. Eventually, once your customer pays the invoice, the factor will then give you the remaining balance of the invoice, minus their fees. These fees are how the factor makes money and are typically a small percentage of the invoice's total value. And there you have it. That's the mechanics of invoice finance loans in a nutshell. It's a way for businesses to secure immediate cash flow by leveraging their outstanding invoices. It's a simple, effective solution that can provide a much-needed cash flow boost when you need it most. With these steps, businesses can secure their cash flow. But what are the key points to remember? Invoice finance loans can be a game changer, but it's crucial to remember some key points. Whether you're a seasoned business owner or a budding entrepreneur, understanding these elements can help you utilize invoice finance loans to your advantage. Firstly, invoice finance loans are designed to bridge the cash flow gap that can occur between delivering a service and receiving payment. This can be particularly beneficial for businesses with long payment terms or those experiencing rapid growth. However, It's important to note that while invoice finance can boost your cash flow, it's not free money. It's a loan that will need to be repaid, often with interest. Secondly, while invoice finance can provide immediate access to funds, it's worth noting that it could potentially affect customer relationships. Some clients may not appreciate your business using a third-party finance company. As such, maintaining open and transparent communication with your clients is paramount. Thirdly, the cost of invoice finance can vary widely. It's contingent on factors such as the size of your invoices, the creditworthiness of your customers, and the terms of the finance company. Therefore, it's essential to shop around and compare offers from different finance companies before making a decision. Fourthly, remember that not all finance companies are created equal. It's vital to choose a reputable company that offers clear terms and has a proven track record. Look for a company that provides excellent customer service and has your best interests at heart. Lastly, it's important to consider the potential risks involved. If your clients fail to pay their invoices, you may be responsible for repaying the loan. Therefore, it's important to have robust credit management processes in place and to only use invoice finance for clients who are reliable payers. Remember, invoice finance loans are not a one-size-fits-all solution, but they can be a powerful tool for the right business. By understanding the key points and potential risks, you can make informed decisions that will help drive your business forward. So, we've learned a lot about invoice finance loans today, but let's tie it all together. At the heart of our discussion, we've understood that invoice finance loans are a powerful financial tool. They act as a bridge to keep the cash flow going in businesses, particularly those with long payment terms. This tool allows businesses to borrow money against the amounts due from their customers, easing the wait for payments and keeping the operations running smoothly. Let's quickly revisit the process. It begins when a business provides goods or services to a customer and issues an invoice. Instead of waiting for the customer to pay, the business can approach an invoice finance provider. The provider will advance a significant portion, often up to 80 or 90% of that invoice's value. Once the customer pays the invoice, the business repays the loan to the provider, retaining the balance minus the provider's fee. This process, as we've seen, provides a lifeline for businesses that may otherwise struggle with maintaining a steady cash flow. It can be particularly beneficial for businesses dealing with clients who have lengthy payment terms, or for those seeking to expand quickly without being hindered by cash flow issues. We also delved into some key points about invoice finance loans. It's important to remember that while they provide quick access to cash, they do come with a cost. The fees charged by the invoice finance provider should be carefully considered, and businesses should ensure that the benefits outweigh the costs. Furthermore, confidentiality can be a concern for some businesses. It's crucial to discuss this with the provider, as some offer confidential invoice finance, where the customer doesn't know about the arrangement. Finally, businesses need to consider their clients' reliability. If a client is known for late payments or defaults, this could impact the business's ability to repay the loan. In essence, invoice finance loans can be a strategic tool for businesses seeking to maintain or boost their cash flow. They offer a way to leverage owed amounts and turn them into immediate capital, thus fueling growth and stability. In conclusion, invoice finance loans offer a viable way for businesses to maintain cash flow and continue growing. Remember, the key is understanding your business's needs and making informed decisions. Thanks for watching.